Our next chart. We talked about this on our investment committee earlier this week. This chart comes from Bloomberg, and it shows U.S. Treasury debt outstanding spiking in October. Austin, when you look at this chart, what does it make you think as it relates to public market equity investing?
Yeah, I think it says a lot. We had a pretty long conversation in our investment committee about the rising interest rates and the impact inflation is having on rising interest rates. And then when we actually pulled up the facts, we realized that is it inflation that's actually driving this dynamic, or is it something else? It does seem like, based on the facts, it's actually just the debt load from the US that's driving up the interest rates, because there's a lot of supply and the demand likely hasn't changed. Now, I think the impact on equities, going back to the question that you actually asked, Jay, is still kind of unknown, because it's unknown if this trend in interest rates is going to remain through the long term. If interest rates remain elevated for longer, you would expect the current premium valuation on equities to come in and markets to trade off. However, given some of the rhetoric around Fed commentary and whatnot, it seems like the Fed might be trying to push this down, even while the federal government is pushing it up with increasing amount of debt issuance.
Adam, what do you think the impact is for investors?
Well, first of all, there's two things that are striking about this chart. One is, of course, the most recent step up, but also just the chart itself, holistically, just a highly sloped line going from the lower left to the upper right. And we kind of all know that the U.S. debt has just ballooned over the last, 4 to 8 years across both administrations. And there's no sign that that's going to stop anytime soon. And it makes me think of that I've said old adage already on the podcast. I'm going to say it again, but that old line about the bond market, which is it works great until it doesn't. And, the fear is that moment when it doesn't, when the market just decides enough's enough, you're too levered, we're not going to lend anymore, rates spike. And we do find ourselves in a crisis that could be as bad as 08, 09. Because we're a credit fueled economy and it's not being managed with any care.